Hello students, today we will be discussing about the specific focused insurance business that is called life insurance. The objectives of the lesson are to teach the students about various types of insurance business, life and non-life insurance business, explain the concept and principles of the life insurance business, nationalization of life insurance business, various types of life insurance policies, claim settlement in life insurance contracts, introduction to life insurance business. The insurance business can be classified into life insurance business and the non-life insurance business. The life insurance business has emerged as a shield against the uncertainties of life and contingencies. The modern concept of life insurance is woven around the three basic principles, that is economics, actuarial and legal. Human life is subjected to loss through a number of serious risks including premature death, temporary disability and total or permanent disability and retirement. All of the above risks land a person in economic and social distress. The life insurance policies come to rescue to the people at the time of distress. In the life insurance business, the subject matter of the insurance is life of a person and the risk is death, which is certain, happening at uncertain times, whereas subject matter of the general insurance is the tangible goods against various types of risks such as fire, accidents, floods, theft, burglary, etc., happening of which result in loss of asset. Life insurance offers a contract for payment of a sum of money to the person assured or his nominee on the happening of event which is insured, such as death to the legal heirs of assured, or on the date of maturity, or at a specified dates as agreed by the parties earlier. Thus, the life insurance cover two important risks: one, untimely or natural death of a person, and in case of survival, payment on agreed intervals of time. The life insurance contract is a contract and parties to the contract are the insurer and insurer. The parties to the contract should have the capacity to enter into the contract. Evolution of life insurance business. The concept of insurance business is age old. The life insurance business is the second in the series after the general insurance inception and grown as outfit of the British insurance companies. Till 1909, no specific law or rules governing the life insurance business was existing. The first attempt to form an insurance organization in India can be referred to the initiations of Sri John Child, Governor of Bombay, who instructed the Court of Directors of East India Company to constitute an insurance office in Bombay. The Oriental Life Insurance Company was started in Calcutta and later Bombay Mutual Life Assurance Society was constituted in Bombay with a capital of ₹7 by Indians and to provide policies to Indians. The Insurance Act 1938 is the exclusive law made for governing the insurance business in India, including the life insurance. In 1950, a committee under the chairmanship of S.R. Ranganathan was appointed to review the control and regulatory system available in the insurance field. On the recommendations of the committee and as per the national economic policy, it was decided to nationalize the life insurance business in India. The nationalization of life insurance business was made by acquiring 243 existing life insurance companies under the provisions of the Life Insurance Corporation Act 1956. The nationalization of the insurance business has brought a great change in the field of life insurance. The life insurance business has become one of the important sources for funds to the government to undertake various development activities for the nation. Section 30 of the LIC Act 1956 has provided an exclusive privileged position to the corporation, which was further extended to all other private players after 2000. Because of monopoly of the life insurance business in the hands of the government undertaking, the LIC, and reforms in economic front, it was felt necessary to liberalize the insurance marketing. Based upon the recommendations of the R.N. Malhotra, the life insurance business, along with the general insurance, was opened to the private players in the year 2000, and the Insurance Regulatory and Development Authority was established on the provisions of the IRDA Act 1999, is regulating the life insurance business thereafter. Advantages of life insurance. The advantages and salient features of life insurance business are: it's a source of savings and inculcating the habit of savings. It provides social security. The policyholder can avail loans against the premium paid. It can be assigned or mortgaged. The LIC, through its subsidiary, grants housing loans against the mortgage. Certain policies cover treatment to serious ailments with additional payment of premium. Tax benefits are given to the policyholders. Life insurance policies create an estate of an individual. The life insurance policies cannot be attached by the courts of law or income tax authorities. Life insurance policies provide liquid cash by way of surrender of policies or loan against the policies. Policies with special riders and schemes can be availed for future obligations of the policyholders, such as children education, marriage, etc. Life insurance contract. The life insurance business is a contract of insurance upon a human life. Parties to the contract are the insured and insurer. The consideration for the contract is the payment of insurance premium by the insured and a promise to pay the money either on death or on maturity of the policy. The insured submits the proposal form duly filled, which contains the personal details, history of health of the applicant and the family, job and occupational, and other relevant information. The insurer, after scrutinizing details and satisfying, will give a notice of acceptance for payment of premium, and the insured pays the premium. Payment of premium is the conclusion of the insurance contract, and the insurer issues an insurance policy, and the insured is under duty to verify the terms and conditions stated in the policy, and if not satisfied, may return back with his comments within 15 days of receipt of the policy. The premium is the essential element of the life insurance contract, and the risk operates from the date of payment of premium. The premium has to be paid in advance. The premium may be paid annually, quarterly, half-yearly or monthly also. Non-payment of premium makes the policy to lapse. The lapsed policies can be validated by paying the penalties or late fee within a period of 5 years. The policies may be surrendered if the policyholder is unable to or becomes incapable of paying the premium for any other reason. Every policy shall have guaranteed surrendered value after a certain period based upon the type of the policy. Grace period of 15 days to 30 days are given to expired policies without payment of late fee. The general requirements of the insurance contract, such as good faith, proximate clause, insurable interest, are applicable to the life insurance contract. The insured is under a duty to disclose all the information about his health history, family health history, occupational hazards and geographical hazards, where he lives, and income which is a source of payment premium. The disclosure of correct age is another important element, failing which the claims may be rejected. The insured is under a duty to inform the insurer the changes that takes place in occupation, place of living and other information which are materially important for the continuing the insurance contract. The life insurance contracts are not governed by the principles of indemnity. In life policies, the subject matter is the life of the assured and the event insured is the death. The loss due to death of a person cannot be assessed, as the gap arising because of the death of a person cannot be filled and the value of a person dead cannot be assessed. Under the distress conditions, the amount payable by the insurance company will come to the rescue of the dependents of the assured. Thus, the life insurance policies are considered as a benefit policies. The presence of insurable interest plays a vital role in the insurance contract. One need not prove the presence of insurable interest on his own life. The law recognizes the presence of insurable interest on the lives of their spouse, and they can purchase policies to protect the lives of the spouse. The law of England and in India recognizes the presence of insurable interest on the children till they become major, but the children have no right upon the parents. A partner has insurable interest on the life of his co-partner to the extent of the partner's share in the business. Let us now look at life insurance business. Section 2, subsection 11 of the Insurance Act 1938 defines the life insurance business as the business affecting contract of insurance upon human life, including any contract whereby the payment of money is assured on death, except death by accident, or the happening of any contingency dependent on human life, and any contract which is subject to payment of premiums for a term dependent on human life, and shall deem it to include the granting of disability and double and triple indemnity accident benefits, if so provided in the contract of insurance, the granting of annuities upon human life, and granting of superannuation allowances and annuities payable out of any fund applicable to solely to the relief and maintenance of persons engaged or who have been engaged in any particular profession, trade or employment, or of the dependents of such persons. Life insurance policies. The life insurance policies are long-term policies. The premiums of the life insurance policies are paid in installments, either monthly, quarterly, half-yearly, annually. Some of the important types of product of life insurance policies include single life policies and joint life policies. Life insurance policies which covers a single person is called the single life policy, and where more than one person are covered is known as a joint life policy. In a joint life policies, one person, all of them can pay the premium. The policy amount is paid either on maturity to all the person jointly or happening of the event to the surveyor of the policy. A policy taken by a partnership firm under which all the partners are covered is an example of joint life policies. Endowment assurance policy. In this policy, the premium is paid for a fixed period. The amount is paid either on death of insured or on maturity of the policy. The policy may be with or without benefits of the bonuses. On death of the insured, the total sum assured and bonus accrued is paid. The policies with the benefit will have extra rate of premium, whereas the policies without profit will have less rate of premium. The policy is payable to the family members on happening of the event or to the policyholder himself on maturity. Whole life policies. The life policy is for a fixed period up to 85 years or throughout the life of the assured. The insurance claim is payable either on the death of the insured or attaining the age of 85 years, whichever is earlier. On the natural death, the insured amount is payable along with the bonus accrued. On the accidental death, double the insured amount and the bonus accrued is paid if provided for. Valued and open policies. The life policies can be either open or valid policies. The insured and insurer agrees beforehand to award the policy and the premium is fixed accordingly. The valued policy is not a policy of wagering contract, and the drawback of this kind of policy is about the system of valuation, which may be subjected to wrong declarations and representations amount to moral hazards. Limited payment policies. In this category of policies, the premium paying period of policies can be for a short term, although policy is for a whole life. The premium may be paid at one time or in installment depending upon the period of the policy. The policy amount is payable only on the death of the person. Pension policies. These plans provide for immediate or deferred pension for life. The pension payments are made till the death of the annuitant unless the policy restricts the period of the payment. In these policies, the insured pays the premium in one lump sum or otherwise, but after a certain period, the insurer arranges the payment of insured amount in monthly installments or otherwise as desired or agreed by the parties. Children benefit policies. The Life Insurance Corporation has been marketing a number of children benefit policies such as Jeevan Balya, Jeevan Kishore, Jeevan Sukanya of LIC. These policies are specifically designed to provide the children higher education expenses with the added attractions of guaranteed additions and family benefit scheme options. Let us understand the claims under life insurance policies. The claims of life insurance policies are paid under two different situations: on the maturity of the policy or on a happening of event of risk, that is death. It is obligatory on the part of the insurer to pay the insurance amount, and insured gets a right to claim the amount of the policy. The insurer, after verifying the facts relating to the happening of the event or the maturity of the policy, about title of the person claiming the payment and identifying the person having the title, arrange the payment to the right person. The insured or the beneficiary, after the date of maturity of the policy, has to claim the payment by submitting the policy document duly discharged, proof of identifying the payee, and other documents such as assignment deed or reassignment deed or any other document in support of the claim. The claim form should be duly filled and signed by the claimant. The claim form along with all other documents should be submitted to the office of the insurance company where the policy is purchased or to the principal place of business of the insurer. The beneficiaries under the insurance policies are the insurer himself if alive on the date of the maturity of the policy, the nominee of the policy as per the provisions of section 39 of the Insurance Act 1938, the assignee or the transferee of the policy as provided in section 38 of the Insurance Act 1938, executors and administrators, joint family members. The first and important beneficiary under the policy is the insured himself. On the date of the maturity of life policy, unless otherwise assigned or transferred, the insured will have the priority for the payment of the amount of the policy. On the death of the assured, the legal heirs will have the priority over any other persons, provided the policy is not assigned or transferred to any person for any purpose. If the legal heirs and the nominee are different, the legal heirs will get priority over the nominees. The nominee will act as trustees for the legal heirs of the insured property. If the policy is assigned to the creditor to secure the loan, the creditor is the person eligible to receive the payment of the policy. The assignee or the transferee for the value consideration will have the priority over any other person. Either on maturity of the policy or on happening of the event, he will get the priority of the payment. On the death of the insured, the beneficiary is under obligation to show the document of title of subject matter, the insurance policy. The insured should establish is the relation and legal right to claim the payment. This requires submission of letter of administration or probate of will. In case of policy with small amounts, the insurer may not insist for the said documents. But under the Indian Succession Act, the property on the death of the insured automatically devolves on the first class legal heirs of the insured, the son, daughter, mother and father. Life insurance policy is as married woman's property. If the insured has made nomination of the policy with an intention to create a security to the wife and children, the policy is treated as the property of the married woman, and the sections 5-6 of the Married Women's Property Act are attracted. If the wordings of the nomination clearly say about the creation of trust for the benefit of the wife and the children, then the insured has no right over it. Once the nominations are made in favor of the wife and children, that nomination cannot be cancelled. In other cases, the nomination can be cancelled. The assured is not permitted to deprive his wife and children from the benefits of the policy. Even the court officials like official receiver or official assignee cannot have a right to proceed against the insurance policy covered by such nomination. The courts cannot attach the benefits of the policy. As such, the particular policy is treated as a married woman's property. Life Insurance Corporation Act 1956. The Life Insurance Act 1956 is enacted with an objective to provide for the nationalization of insurance business in India by transferring of all such businesses to a corporation established for the purpose, and to provide for the regulation and control of the business of the corporation and for the matters concerned with or incidental to. The Act came into operation on 19/6/1956. Thus, it has three important objectives, such as nationalization of life insurance business that is existing in the hands of fragmented small players in India. B. Establishment of Life Insurance Corporation of India, that is LIC, for the purpose of transferring and the existing life insurance business and conducting the future business in life insurance segment, and regulation the control of LIC for the effective and efficient business. Chapter 4, having the section 7 to 17 and schedules of the LIC Act 1956, contains the provisions related to the acquisition and transfer of the life insurance business organizations to LIC. There were about 243 players in private sectors from India and abroad were operating in the life insurance business. The Act empowered the government to take over the business along with assets and staff of the companies and transfer the newly formed the LIC of India. Thus, the life insurance business has become the part of the government company and has a monopoly to undertake the business and facilitating the government to use the unused funds of Life Insurance Corporation for the national development. Chapter 2, concerning section 3 to 6, has the provisions of establishing LIC. The LIC is a corporate body having a perpetual succession and a common seal. It is established with an initial capital of 5 crores and later enhanced to suit the regulations of the IRDA. The corporation is managed under the supervision of Executive Committee consisting of 16 members appointed by the central government by notification. The corporation shall have a chairman and full-time managing director, and they conduct the business under the directions of the central government through its zonal offices, division offices and branch offices spread over the country and abroad. After the establishment of IRDA, the LIC is also under the scanning of the IRDA. Functions of LIC. The LIC Act 1956 defines the functions of the corporation, such as it carries the business of capital redemption, reinsurance business and certain annuity business of life insurance. It lends or advances money on security of any mobile or immobile property or otherwise. It has the power to invest funds for the benefit of the corporation, to transfer the whole or any part of the life insurance business carried on outside India to any other person or persons in the interest of the corporation, to hold and maintain the provident, superannuation and other life funds for the benefit of the policyholders, shareholders and for settlement of claims. Corporations are under duty to settle the claims of insured in a reasonable time, duty to maintain the accounts and arrange the auditing of the accounts, duty to safeguard the interests of the property which is in the possession of the corporation. With this, we can understand the establishment of the life insurance corporation, its functions and the regulatory mechanism of life insurance business in India.